No IRS penalties, no tax, and no need to time the market. In this episode, I'm going to answer the question, how easily can I access money out of an IUL policy? That's an indexed universal life policy. You're going to be blown away with how easy this is. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for more than 48 years. And I've been around the block. In fact, some call me the godfather of IUL and whatever, because I began using universal life when it was first introduced in 1980, because I used to be prior to that. I started in 1974, and I had over 3,000 clients I was responsible for in 13 Western states. And I was a big proponent of buy term, invest the difference. And E.F. Hutton actually created universal life. It wasn't whole life, it wasn't term, but it was actually how to buy term and invest the difference under a tax-free umbrella. So it's like buy term and invest the difference on steroids. And a lot of agents still don't understand that here today. But in this episode, I'm going to address how easily you can access money out of an IUL policy. And a lot of people don't understand the term liquidity. So this is going to teach you that when you need to access money for an emergency, a business opportunity, whatever, the procedure is actually much easier than most people think, especially the general public. So if you are a licensed insurance agent selling IUL, listen very close to how you can explain accessing money out of an indexed universal life policy. So when you need to access money out of your IUL policy, and sometimes people have been funding it as fast as the IRS allows under the TAMRA tax citation. So let's say they have a policy that will accommodate a guideline single premium. And if you don't understand that term, it's explained on other episodes. And so if you wanted to set aside $500,000, $100,000, $1 million, you know that if that's the guideline single premium, if you put all that money in all at once, since the TAMRA law was passed in 1988, if you go to access money, it's going to trigger tax, and it's going to be taxed LIFO, last in, first out. You're going to have to pay tax just like you would if you were accessing money out of an IRA or 401k. Now, there won't be a 10% penalty, but no, most of my students and clients, they wanted to access money without triggering tax. That's one of the benefits of IUL. So if you were putting in, let's say, $100,000 a year, and in 4 years and 1 day, you finally got all of your $500,000 in. Now you've complied with TAMRA, if you were, let's say a 60-year-old, and now you have $500,000 in there. And if you earn the rates of return that I've earned, averaging in that 7 to 10% range, that $500,000 will double every 7 to 10 years to $1 million. $1 million doubles to $2 million. $2 million doubles to $4 million. $4 million doubles to $8 million. And I've actually had clients who 30 years ago started out with $500,000 and they have $8 million today. Okay. Anywhere along the line, if they need to access money, they know to just call me, and I send them the form. I just email them a one-page form with that particular insurance company. And it's very easy. Across the top, they just write their name and their policy number, which would be like an account number. And then there's usually two choices, boxes that they can check. One says, would you like to withdraw some money? And they put in the amount. So let's say they have $500,000 in there and they want to withdraw $100,000. Do you want to withdraw, or would you like to borrow $100,000? Now, what do you think most people check? Borrow, because they've learned how to do it the smart way. Now, be sure and check out another related episode to this, because I address 3 ways to access money out of an indexed universal life policy: the sad way, the dumb way, and the smart way. The smart way is by borrowing instead of withdrawing money, and you'll understand why. But the point is this, it's one page. Most of my clients, without me having to remind them, if not, then I remind them on why the borrowing method is the smartest way to do it. And they just check the box, they sign it, and they put down the address to send the check to, or the account number if they want it wired, if the insurance company allows that. And unless the address is different than the one on the insurance company's records, they don't need to verify. And sometimes I've been able to arrange for an electronic funds transfer, but most people will just wait until the check is sent to them, and you can request that it's overnighted and what have you. But it is that easy to be able to just access money. And if you use the loan provision, it's not like applying for a loan at a bank or credit union where you have to apply and then wait to be approved, and they check your credit and you wait 2, 3, 4, 5, 6 weeks to get approved and then get money out. See, when you access money out of where most Americans have money accumulated, IRAs and 401ks, what happens when you access the money? You have to pay tax. Otherwise, you have to arrange for a loan, and then you must get on a schedule instantly of paying that loan back, or else the employer is required to report that as income, and you have to pay tax. If you're under the age of 59 and a half, there's a 10% penalty on top of the tax. That is not usually what people want to incur when they access money out of an IRA or 401k. Same thing if you have money in a mutual fund or stocks or bonds. If you access money, sometimes you have to time the market, and if the market's down, it's not a good time to sell. You want to sell high, not low, okay? And so that's why an IUL policy is usually the absolute best way to access money for an emergency. It's the ultimate emergency fund in my mind. But how easy? It's one page. And you simply fill out name, account, or policy number, and check the box on how you want to access it via a withdrawal or a loan. You sign it, and if it's going to the same address on record, that's it. They verify. Now, there's fraudsters out there that'll try to do that, and that's why they check the address to make sure it's going to the proper person. But even if there are fraudsters who try to do things, usually the insurance company is very sharp in catching that. And that's why they'll trace it and what have you. Let me connect the dots on why this is such a powerful tool when you need to access money for any reason, a business opportunity, a real estate deal, or just a flat-out emergency that happens in life, a major car repair or anything. Now, if this is intriguing you, I'm not done here, but listen, subscribe to this channel. It's free, and when you do, click the little bell, and then you'll be notified every time I post a new video, which I do almost on a daily basis, and I don't want you to miss out. But if this is resonating with you, be sure and share this video with somebody, post a comment, click like, but stay with me to the end because I want to gift you a copy of my most recent 300-page best-selling book called The Laser Fund. Let me give you an example of several times when I've had clients who have accessed money. And I have a very sophisticated client. He's a real estate investor, and he usually buys these huge apartment complexes. And he will find those that are distressed, that need to be fixed up, and the seller just wants out, they're retired or whatever. And so he makes it a win-win. He doesn't buy the property for himself. He buys the apartment complex, maybe for 20, 25 million or whatever. And he buys it, and he fixes it up, and then he flips it, and he sells it because he has a whole pool of investors who want apartment complexes once they've been fixed up. And he just makes the money on, just like somebody who buys and flips houses. So many times he will call and say, Doug, I need $1 million out of my IUL policy, because he has several million. And I'll say, okay, and I send him the form. In fact, now he just says, email me the form, or I've still got a copy of it. He puts his name, his policy number at the top of the form, and then he checks which box, withdraw or borrow. He always borrows. So be sure and watch the episode on why this works, but let me just give you a sneak preview. So in 2017, the market was up. He borrowed $1 million out of his policy. Why would you borrow your own money? Well, because he wants to put it back. If you withdraw it, sometimes you're restricted on putting it back. But why would you borrow and pay interest? He can borrow at zero net cost. He could borrow at 2% and they'll credit him 2%. But instead he borrows and says, you can charge me 5%. So that year they charged him 5% on $1 million on his statement. That's 50 grand. Why did he borrow? Because it was an index loan. He understands this. That year, he got credited 25% on the $1 million that he did not withdraw. It's still sitting there. It was the collateral that the insurance company used to loan him $1 million using the $1 million he had there. So he earned 25% on his $1 million that he did not withdraw. That's $250,000 of tax-free interest. And they subtracted the $50,000 loan fee, and he netted 20% or $200,000 of growth on his IUL policy while he was using that $1 million in his business to make a lot of money flipping apartment complexes. This happened again in 2021. We had people borrow money at 5% out of their policies and they earned 32%. Some even earned 61.33% on their cash values in their policy while they were using their money for other purposes. Does that blow you away? It ought to. So, in summary, money in an indexed universal life policy, in my mind, is way more liquid than money trapped in IRAs and 401ks that will sometimes require that you pay tax and even penalties to the IRS, or money trapped in the market because then you have to time the market. I don't have to worry about that. I borrow the money out and I keep earning interest on the cash that I did not withdraw. And this is how money works. So, if this is intriguing you, I want you to learn more. So, I'm going to gift you a free copy of my most recent best-selling book, and you'll read stories and examples of how people use IUL for all kinds of purposes, but one of the big reasons is because it's so liquid. This is my 11th book. It's called The Laser Fund. And it's actually 300 pages, 2 books in one. This side, the white side, has 14 chapters, 200 pages with all the charts and graphs and explanations of how to diversify and create the foundation for a tax-free retirement or other goals. If you learn more by stories, you flip it over and read this one. This is 12 chapters, 100 pages with 62 actual client stories. And all you need to do is click on the link below, laserfund.com. Go to laser, L-A-S-E-R, fund.com. You contribute a nominal amount towards the shipping and handling. And I will fire out both of these in one book to you. And you contribute a nominal amount, I will pay for the book. And then there's other options in there to listen and learn, watch and learn, but check out some of the educational courses that are in there, especially Retire by Design. You can attend virtual classes of that we hold on a periodic basis. Don't miss out. This is your key to a brighter future with more liquidity.